Everybody for joining us here today. We're going to talk a little bit about what's going on in 2022, talk a little bit about some year-end tax planning opportunities, what legislative updates there were during the year, and what we think the future holds. My name is Sarah Russell. I lead our tax department here at Clayton and McCurvey. Clayton and McCurvey is about an 85-person firm, full-service firm, but focusing on closely held businesses. Tara Ablett is here today as well. She'll be helping me answer questions as your questions come in. If you have questions, please post them in the Q&A section, and Tara will be monitoring that and may interrupt me as we present a little bit throughout the day. Couple of housekeeping items. We will do our best to end promptly at 11:30. We respect your time and understand that everybody's busy. So with that being said, I'll sort of jump right into it. Our agenda today is just to talk a little bit about a 2022 general overview. Like I said, we'll go through the legislative updates. There hasn't been a lot this year, but we'll talk about what did happen. We'll talk about a few year-end tax planning strategies, and then what we're thinking 2023 may look like. So when we look at 2022, I think everybody can agree there were a fair amount of business challenges this year, from a tight labor market, continued supply chain disruptions, high inflation and recession concerns, continuing increased interest rates, which resulted in higher borrowing costs for most people. But the good news is there was minimal tax legislation. Good news from my perspective, anyways, as a tax professional. While we expected there to be a significant amount of tax legislation, they weren't quite able to get some of their goals accomplished in Congress this year. But I do know increased interest rates has been a big struggle for a lot of business owners, and we expect that to continue into 2023. I know the Federal Reserve has been trying to ward off a recession and has continued to increase interest rates at a pretty high clip here. About each time they increase interest rates, it's been about 75 or about 0.75%. And we're expecting another increase probably in December when they meet. I think they meet next week on December 13th and 14th. And the expectation is that another 50 basis point increase is going to occur. From what I'm hearing through economists and whatnot, we believe that the Federal Reserve is pegging close to a 5% interest rate by the time we get through mid-2023. And then probably it'll settle down. So that's some expectations as far as where interest rates are going. And we'll talk a little bit about the impact of that as we get through talking about some of the 2022 tax planning strategies and 2023 outlook. So what legislative updates did occur during 2022? We had the Inflation Reduction Act, or also known as the IRA. And then we also, towards the end of 2021, had what's called the CHIPS Act, which is the United States Innovation and Competition Act of 2021. The IRA bill was not a tax-heavy bill, but it did have a few tax items in there. The bill was mostly focused on investments in climate protection. So it did include some tax credits for households to offset energy costs or investment in energy efficient systems. There is a tax credit in there. It's called the Advanced Manufacturing Production Credit. And it's available beginning in 2023. So it's not a 2022 tax credit, but it is something that if you are producing components for within the wind, solar, battery projects, in that sort of industry, it's possible that there could be a credit available to you in 2023. The credit rates vary depending on the component, with some rates depending on the cost of production and others based on certain capacity factors. We're still waiting on guidance, so we don't have a lot of information on how this credit is exactly going to operate, and we don't have a lot of detail on what's going to be eligible for the credit. We have some broad information as far as, it's eligible components are components within wind, solar, and battery projects, but we don't know exactly what that means. There are some definitions, they're pretty detailed, and I'll admit that some of the terms, I don't know what they mean because they're pretty technical when you get into those when you get into those industries. But if you're doing any manufacturing or supply, you're supplying solar industry or wind turbines, components for wind turbines, or even certain electric vehicle plants, you may be qualified for this credit. And so it's something to certainly keep an eye on to make sure you don't miss out on this credit in 2023. It will be, as far as I can tell, a general business credit. So it'll go on a form that already exists. So I don't think the reporting of the credit is going to be that complicated. It's just a matter of doing the calculations and determining your eligibility for that credit. The CHIPS Act provisions are more targeted towards incentives for taxpayers that are considering constructing semiconductor manufacturing facilities. So, as we've seen some supply chain disruptions occur due to COVID, especially in the chips market, Congress passed legislation that's trying to incentivize taxpayers to sort of onshore the production of computer chips or semiconductor manufacturing. And so they're providing credits and grants for taxpayers that are constructing manufacturing facilities for this purpose. I know recently there was, I think President Biden just yesterday was in Arizona. A big company is coming in, I believe it's from Taiwan, and they are building a new semiconductor manufacturing facility in Arizona, and certainly taking advantage of the incentives that are available under this CHIPS Act. So if that's something that you're doing, or you're refitting your manufacturing facility to help build some computer chips, this is something that you would want to be looking at to make sure you're taking advantage of. So I mentioned in the IRA, there are some green energy provisions. There's quite a few of them. I sort of looked at it and said, hey, looking at our target client base, what are the provisions that I think most of our clients may be able to take advantage of? And this is really not going to be, generally speaking, at the business level. It's going to be at your individual level. So if you're buying an electric vehicle, there's been a clean vehicle credit out there, or credit for EV vehicles for some time. Those credits were set to expire in 2021. The IRA has extended those credits, and it's changed the credits a bit. So if you're buying an electric vehicle, there's always been a list of vehicles that are qualified for those credits. That's going to change a little bit because there's a new requirement in there, and it begins the date of enactment of this legislation, which was August 16th, 2022, that says there's a requirement for final assembly in North America. So it's probably going to limit the availability currently for those credits. I think there may be some changes in electric vehicle production to make sure that those cars are being qualified for the credit. But initially, that's going to be a tough sell because people can't just change these things on a dime. And so you may look at it and say there's a dip in vehicles that are eligible for the credit in 2022 and 2023, and then sort of goes back up to 2024. The credit is worth 30. There's also a credit for alternative fuel refueling property credit. This has also been in existence, but was set to expire in 2021. The credit is now available starting in 2024, or is now available through 2032, I believe, and it's 30% of the cost up to $1,000. The other item for the clean vehicle credits is starting in 2024. This allows you to transfer the credit to the dealer. So basically it allows you to get an immediate in-purchase discount instead of waiting until you're filing your tax return to claim the credit. So that'll be available starting in 2024. So if you're in the market for an electric vehicle, make sure you're looking at these credits, determine, if that's going to be a driving factor for you, determining whether or not the vehicle you're looking at is going to qualify. And hey, does it make sense to wait maybe a year to buy the car if getting a current discount on that purchase is something that's important to you? There's also some energy efficient home improvement credits. Again, these are extensions of credits that have existed that were set to expire in 2021, and also changes the credits a bit. The energy efficient home improvement credit, previously, this credit, when it had existed before, was limited to $500 in your lifetime. So if you're installing energy efficient, qualified energy efficient systems like a furnace, AC units, hot water heaters, you're putting insulation in to make your home more energy efficient, that sort of those sort of systems generally has qualified for the credit, but you were limited and you could only get $500 in your life. So basically, most people would get the credit one time and they would never be able to get it again. The IRA changes that so that now you can take up to 30% of the costs, but it's $1,200 per year. So you can continue to get this credit anytime you're making an improvement in your home. The credit applies, though, to January's completed beginning in 2023 and until the end of 2032. The residential clean energy credit is a similar credit. It's 30%. It doesn't have the $1,200 limitation for the cost to install certain qualifying systems that use solar, wind, geothermal, biomass, or fuel cell power to produce electricity, heat, or regulate the temperature in your home. The credit begins to the credit's available beginning in 2023, and it begins to phase out in 2033, so 10 years from now. Tara, do we have any questions so far?
No questions yet, Sarah.
Great. So those were the two big legislative updates that happened during the year or towards the end of 2021 that may impact you in 2022 and certainly potentially in 2023 if you're doing anything that's to your home improvements that is going to be energy efficient. But there are certainly several expiring tax provisions that either expired at the end of 2021 or expiring December 31st, 2022. The biggest one that is causing a lot of concern, both in practice and for the business owners, is the research and development expensing. The Tax Cuts and Jobs Act that was passed in 2017 included a provision that requires research and development costs to be capitalized and amortized over a 5-year period. Prior to this going into effect, you could immediately expense research and development costs. The provision is under Section 174, and it requires basically all costs that are defined under Section 174 to be capitalized and amortized. And the amortization is over 5 years, but the rule reads that the first year you only get 10% amortization, and then you get 20% years 2, 3, 4, and 5, and then in year 6 you would get the last 10%. So it's really almost amortized over 6 years. And this is a big issue. If you've been historically taking the research and development credit, you have essentially, one of the qualifications for the credit is that you have to have expenses that are qualified under the Section 174 definition. And so, it would seem to be that those expenses would now be required to be capitalized and amortized. And this, if you look at clients that are taxpayers that are taking the credit and are, a lot of our R&D tax credits are sort of recharacterizing trade or business expenses or cost of goods sold, talking about wages and supply costs for projects that are qualified for the credit, could now potentially be required to be capitalized and amortized. There is some theory and practice that potentially that's not the way this rule was meant to be written. Everybody in practice assumed that this rule would not actually go into effect, that it would be corrected before it actually took effect. It has yet to be corrected. There is a fair amount of bipartisan support to correct this issue. It just hasn't been able to get passed yet. It was included in the Build Back Better Act that didn't get passed last year that we thought might get passed. But Senator Joe Manchin really wouldn't vote yes on it and stop that, sort of block that bill from being passed. But It's expected that this could get passed in an extender package. We're not sure. But keep in mind that if this doesn't get fixed and this is the rule you're stuck with, there is probably a fair amount of work that needs to be done to determine what your research and development costs are that are going to be required to be capitalized. I do have some taxpayers who have said, well, maybe I just won't take the credit, because if I don't take the credit, then I'm not claiming that I have any research and development costs. I don't think that that would be a consistent tax position to take. If you have been taking the research credit all along, you've been sort of asserting all along that you have expenses that are qualified under Section 174. And I think if you sort of changed your mind in 2022 and said, no, I don't anymore, you may call into question whether or not you were filing for a valid research credit. So I don't think that that would be a great tax position to take. There's also some thought that potentially Section 174 doesn't apply to an ongoing trade or business. When Section 174 was drafted, it was written to help startup companies and put them on sort of the same level playing field as operating companies were, because there was legislation that was out there, and this goes back quite some time, that disallowed startup costs from deducting certain costs that were eligible to be deducted from an ongoing operating company. And so Section 174 was instituted to sort of allow them to expense these costs as they were incurred, if they so choose. It gave startup companies the option to capitalize and amortize those costs, or expense them. So they could do either or. And so there has been some thought that potentially these Section 174 costs are only meant to be for startup companies, and therefore Section 162, which is your trade or business section, where you're able to deduct ordinary trade or business costs, Section 172 or 162 prevails over Section 174. I've only seen this theory and this opinion by one person. However, if you were to look at the committee reports from the Tax Cuts and Jobs Act, that doesn't seem to be the intent that they were trying to do. And, if you go back to when the Tax Cuts and Jobs Act was passed, this was passed under the reconciliation process, which required certain revenue raisers to be included in the bill. And this was one of those revenue raisers that allowed them to pass that bill under the reconciliation process. I have a fair amount of optimism that this rule will get fixed. I don't know if it'll get fixed before the end of the year, or, there's been some thought that it might not get fixed until Q1 2023, but the fix would be retroactive to 2021. So, there could be some taxpayers that are extending their returns that don't normally extend their returns, keeping an eye on what's going on in Congress and what's developing on this issue. So this is a pretty big issue and could cause a substantial impact to tax returns in 2022, because this legislation went into effect as of 1/1/2022. So that's a huge issue that's out there for 2022 update. A couple other issues that are pretty big is, again, the Tax Cuts and Jobs Act. So a lot of rules were instituted and were written as such that they changed over time. And again, this goes back to because they were trying to include revenue raisers in the bill, or draft this bill so that it met the budgetary requirements to be passed into reconciliation. A lot of things either phased out or started changing over time. And one of these is the limitation on interest deduction. So it's called Section 163J, and there's a calculation that you've had to go through to determine how much of your interest was deductible for business purposes. That calculation started out at, it's called adjusted taxable income. And in that calculation, it allowed you to add back depreciation. That depreciation add back is no longer available in 2022. So it changes that calculation. And you're only allowed to deduct business interest in 2022 up to 30% of this adjusted taxable income. So that'll change that calculation and of that limitation for a lot of taxpayers this year. If you think manufacturing taxpayers are heavy, usually on depreciation, they have a lot of machinery and equipment. This will be a big change for that deduction. So it's possible that some of your interest may no longer be deductible, or will be that deduction will be limited. Bonus depreciation has been around for quite some time. This was something that was passed back during the Bush administration and has come and gone or has changed over time. It got extended with the Tax Cuts and Jobs Act, but begins to phase out in 2023. So bonus depreciation will be reduced to only 80% in 2023 from the 100% that it exists as of 2022. Charitable contribution deductions will change. The CARES Act allowed 100% charitable contribution deductions up to 100% of AGI. That phases back down to 60%, which is what it was before the CARES Act, which was some of the legislation that was passed during COVID to help taxpayers. The extended child tax credit, which was also a COVID legislation, that's expiring in 2022. It doesn't exist this year. So there could be some taxpayers who have been getting this extended child tax credit they won't get that again in 2022. This has been a big sticking point between Republicans and Democrats. Any tax legislation that has been tried that they're trying to compromise on, this has been a sticking point. There are some Democrats that are somewhat digging their heels in, saying we won't pass anything unless this gets attached to it. So this is something that could get extended to a certain degree. I don't think it'll exist the way it existed with some of the legislation that was passed during COVID, but it could get extended to with some sort of guardrails on it. We'll see what happens. A big change this year is Form 1099-K. This was required to be filed last year and is somewhat new. It's for payments made through third-party payment settlement networks like Venmo or PayPal. Last year, the threshold was $20,000, and I think it's per transaction. And this year, it's reduced to $600. So a lot more 1099-Ks will be coming out there. And the biggest impact is both if you're a business that's accepting these payments, you may have these 1099-Ks that you need to file, but for taxpayers that are used to filing pretty quickly at the beginning of the year, I suspect that these 1099-Ks will lag a little bit because it's a new requirement. And so you may not be able to file your tax return until a little bit later than what you're normally used to, because these 1099-Ks may not come out until a little bit later. And then last year, there was a new schedule for pass-through entities. There were Schedule K2 and K3 were new forms that needed to be filed with the Schedule K1. The Schedule K1 is the form that shareholders of pass-through entities get reporting the income that they need to report on their return. There were some exceptions that got implemented pretty late last year that said, hey, if you meet certain requirements, you don't have to file these K2, K3s because they're pretty lengthy. There's been some updates on these schedules this year that, those exceptions are no longer applicable, but potentially if you don't think that you have transactions that are recorded to be reported on these schedules, then you may be able to notify your partners that you're not filing these forms, and your partners will have the opportunity to ask for it. Generally, these forms were implemented because if you're doing business internationally, if you have a foreign subsidiary or a foreign branch, or you do a lot of export business and you have some export sales, you may be required to file this. It's supposed to give the shareholders of these pass-through entities more information to properly calculate foreign tax credits or do their own foreign reporting on the returns. And so there's some exceptions there, but something that you'll have to work through and could again delay the timing of when K1s come out because of the information that's required to be reported on Schedule K2 and K3. Last year, the IRS wasn't even able to accept these forms in electronic format until midsummer. So the IRS has had a little bit of a hard time getting acclimated to getting these forms filed. I don't expect to have that issue again in 2020, in the 2022 filing season. But certainly they're making updates all the time. And we just got new instructions for these forms on December 2nd. So they could present another challenge during the filing season this year. Any questions there, Tara?
We are still clear of any questions at this moment.
Great. So when we look at year-end tax planning considerations, planning for 2022 looks a little different than it has the past few years. The past few years, we've had significant amounts of legislation that was passed to, help taxpayers navigate through COVID and to sustain certain businesses during these uncertain times. But as we've mentioned, there hasn't been a whole lot of tax legislation passed this year. So we sort of revert back to pre-COVID tax planning, and that it's a little bit of some of the usual things that we've talked about for many, many years. The newest one out there, though, and this happened, this has been existent in the past couple of years, but is the state pass-through entity tax election. So the Tax Cuts and Jobs Act limited the deduction business or individuals could take for state and local taxes to $10,000. And this legislation really impacted pass-through businesses because pass-through businesses pay their taxes on their individual return. And so basically what it did is it disallowed deductions for state income taxes on your business income. Most individuals, their individual tax rate for other income outside the business and plus property taxes, they easily met that $10,000 without paying any taxes related to their business income. And so, frankly, it disallowed the state tax deduction and put pass-through entities on an unlevel playing field compared to their corporate peers. So many states have gone through and said, okay, well, we'll pass a fix for this, and we will allow pass-through entities to make an election to pay the state income taxes at the pass-through level, basically putting the pass-through entity on the same level playing field as a C corporation. It's an election that all of the states are different. There's a lot of nuances to it. A lot of thought should go into whether or not you make the election. Some states, the election is year by year. Some states, the election is for 3 years. And so there's some thought that really does need to go into it. On face level, it seems like, oh, this is a no-brainer. I want to deduct my taxes, so I'm going to make this election. But you really do want to put some thought into whether or not it makes sense for you. And basically, the effect of it is to reduce the business income that flows through to you on your personal return, and thereby giving you the benefit of the deduction. The other planning consideration, we talk a lot about research and experimentation tax credits. And, there's always taxpayers out there that are not taking advantage of the tax credit that should be, but certainly give some consideration to whether or not you're doing qualified research activity that would qualify for the credit. And again, even though Section 174 now states that you have to capitalize and amortize your research costs, just because you're not taking the credit, if you have costs that are defined, that meet the definition under Section 174, I do believe that capitalization policy applies to you. So you should still go through the exercise to determine whether or not you have any costs that are required to be capitalized under this new regulation. And if you do, then I would say you should take it a second step and determine whether or not you qualify for the credit. because the qualification for the credit isn't just that you have to meet definitions under Section 174. There's certainly other qualifications in there, but that's the first step. A couple of other items I just wanted to mention on the research and experimentation tax credit, though, is we have been seeing a fair amount of increased oversight in this area. There's certainly some new court cases out there. I think they're being challenged through the appeals process. Some of the court cases that are out there are contrary to other established case law. So I think there's a fair amount of sort of uncertainty as to where some of these court cases are going to land. But there has been an uptick, I would say, in the scrutiny on the research and experimentation tax credit over the last 18 to 24 months. So something to be aware of, and certainly talk to your advisors about if you're taking the credit. The other credit that's out there that you want to make sure you haven't missed is the employee retention credit. This was a credit that was enacted with COVID legislation. And I do think that a lot of taxpayers that may qualify for the credit haven't paid close attention to it. So it is something that you'd want to just make sure, have you done the analysis? Have you determined whether or not you qualify for the credit? And if you qualify for the credit, have you applied for the credit? It's a payroll tax credit. So if you haven't taken the credit, but you do apply, you would need to amend payroll tax returns. And I will say that getting the refunds on these amended returns takes quite a bit of time. We're seeing 9 to 12 months is not uncommon. So it's something that you want to look at, and if you qualify, you want to get those done as soon as you can. Other standard sort of year-end tax planning considerations is making sure you're reviewing your accounting methods and elections. So we talked about, interest rates are going up. It's resulting in higher debt costs. And so a lot of business owners are saying, now is the time to start preserving cash. And you combine the higher debt costs with what is likely going to be further limitation on how much you're able to deduct for that interest expense. If your interest expense is going up and your adjusted taxable income is going down because you have more interest expense, that formula may further limit your interest expense deduction, further increasing your cost of debt. So reviewing your accounting methods and elections to see if there are ways to defer current tax liabilities. Now is the time to really look at that and make sure that what you're doing is the most tax efficient for you. There may not be a lot possible there for you, but it's certainly worth a review with your advisors to make sure that you're doing everything you can to sort of help preserve as much cash as you can and defer those tax liabilities. Bonus depreciation in Section 179. As I said before, bonus depreciation is going to be it's going to start to phase out. In 2022, you get 100% of the cost of fixed assets placed in service. In 2023, that'll be reduced to 80%. So looking at, are there any items that you should be purchasing before year end to take full advantage of the bonus depreciation is probably something you'd want to be looking at. Section 179 is similar to bonus depreciation. It just has limitations on it. Bonus depreciation is not limited to taxable income. You can take bonus depreciation and create a net operating loss. You cannot do that with Section 179. So just taking a look and making sure you're taking full advantage of those two things before year end, if possible. The other thing I suggest you do is reviewing your assets. There's been a lot of economic uncertainty with COVID, with the high inflation rates that are out there, with the supply chain disruption. All of these things lead to a lot of focus on, managing the business. And I think you can lose sight sometimes as to taking a look and at your assets and seeing, is there anything that I have on my books that is really not valuable anymore? Now, this certainly isn't fixed assets that you're depreciating. If you're still using them, you can't write them off. But really looking at the assets on your balance sheet and looking at, is there things that should be written off? Do I have old receivables out there that I'm really not going to be collecting, that are sitting in a reserve? And remember, reserves are not deductible. You actually have to write the receivable off. But sort of taking a hard look at that this year to see if there's things you should be doing to actually get rid of these assets so that you can take the deduction in the current year. Any questions, Tara?
We still do not have questions. A quiet audience today.
That's okay. Other year planning considerations, and this is more if you're looking at it from your individual level, not at the business level, is certainly reviewing your portfolio and determining if harvesting capital losses is beneficial. I know the stock market's been pretty volatile this year. So if you have some assets in your portfolio that you think are not going to recover, that you have, capital losses on, and at the same time you have capital gains, realized capital gains in other places, you may want to consider harvesting those capital losses. I never recommend taking a loss if you think that asset is going to recover. For tax purposes, you'd rather have the asset appreciation, but looking at those assets, sitting down with your portfolio advisor and making sure that you're doing what makes the most sense for your portfolio. I'd say I would be having those meetings with your advisors before the end of the year to make sure you're doing that. If you've bought an electric vehicle car, or if you've made any home improvements during the year, I would review the energy credits to make sure that you're taking anything that is available to you, making sure you're maximizing the use of those credits. Consider gifting appreciated investments. If you're, or even gifting, if you're a business owner and you own, you have kids that you're going to be turning the business over to, is now the right time to start gifting a percentage of your business to get that out of your estate. You always want to look at, you want to gift those, anything like that when the value is lower. So maybe you look at it and say, oh, I think we're going into a recession in 2023. I'm going to have a down year. Maybe you consider that gift when that value is lower, so maybe that's next year, not this year, but making sure that you're thinking about those things. Or if you have, it's not just limited to your business asset. It could be any assets that are appreciating in value. Always consider IRA contributions and look at whether or not doing a backdoor Roth conversion makes sense. Is always a good idea to be looking at during your year-end tax planning. So we talk about 2023 and what do we think is going to happen? I mentioned this before. Economists tend to believe that interest rates are going to continue to increase. I know Jerome Powell came out in November and he said, he was sort of cautiously optimistic that maybe the Fed would slow down the rate of increase. It's widely expected, like I said, that there's going to be another 50 basis point increase coming out at their meeting next week in December. And, I think in September, economists were saying they believed that the interest rate target was going to be about 4.6%, probably by June 2023. They've increased that to 5%. Inflation hasn't quite slowed down the way some thought it might. In November, the numbers that came out, it ticked down slightly, but it didn't tick down as much as I think some were thinking it would. Although Jerome Powell has said sometimes monetary policy takes a while. It takes a while for the economy to catch up to that monetary policy. So we'll see what happens, but I wouldn't be surprised if interest rates by June 2023 are somewhere between 4.5 and 5%. With a split Congress, just going back for a second, so it's just going to further increase your debt costs. And so thinking about that as you're doing cash flow projections, I think is going to be really important. With a split Congress, I think significant tax legislation is probably unlikely, although not impossible. With the Republicans holding a thin majority in the House, I think it's going to be a pretty big challenge for the Democrats to get a huge sweeping tax bill passed. I wouldn't be surprised to see something, some sort of compromise come out. And I'm hoping for maybe some lame duck legislation on an extender package come out sometime in the next few weeks. Although I do recognize that Congress has a fair amount of tall tasks in front of them with, actually just getting government funding, a government funding bill passed, defense spending bills passed. So they have some huge priorities on their plates. But I feel fairly hopeful that something will either get passed before the end of the year to extend some of these provisions that were set to expire, or if not before the end of the year, in Q1 2023, once the new Congress takes place. So we'll see what happens, but I doubt that there will be significant tax legislation in the current year. However, one thing to think about is many of the Tax Cuts and Jobs Act provisions are set to expire in 2026. So, it feels like it's far away, but it's really not that far. And some of the biggest tax rates that are set to expire, the biggest one is the qualified business deduction, right? Right now, pass-through entities, the income passes through to the shareholders. The highest tax rate currently is 37%, but you get a 20% deduction for business income, which makes that effective tax rate on your business income 29.6%. In 2026, that will go back up. And not only does that 20% deduction go away, the tax rates go back up. The tax rates go back up to what they were prior to the Tax Cuts and Jobs Act. So you're looking at an effective tax rate on that business income for federal purposes only of 39.6%. So it's going to be a big difference. You're talking about a 10% change in your effective tax rate on that business income. So I think, making sure if you're doing long-term forecasting that you're considering these Tax Cuts and Jobs Act provisions that are set to expire. The corporate rate is currently permanent at 21%. So that may be another thing that you sort of look at your entity structure in these exercises to determine, does a pass-through entity continue to make sense? Now, certainly anything could change before 2026. We'll have a new president, or there'll be another presidential election by then. Congress could change and be, all Democrat or all Republican, and additional tax legislation could get passed, and some of this stuff may not matter. But I think losing sight of what those cash impacts on your business may be in 3 years from now, you may not want to do that. You may want to be prepared for what that looks like if things should convert back to what they were before the Tax Cuts and Jobs Act. Other things to consider, I think in this environment, be agile and keep an eye on potential extender legislation before year end and what it could mean for you. If something gets passed, how does that impact maybe some planning strategies you're thinking about putting in place, and what maybe do you sort of hold back on because you don't need to. Everybody likes to be prepared for the end of the year, before the end of the year, but I think we're in a situation right now where we're not exactly sure what could get passed before the end of the year. As I just talked about, start considering how sunsetting Tax Cuts and Jobs Act provision impact you. I think now is the time to really start looking at that and planning for that. And then, qualified small business stock planning opportunities. Qualified small business stock is an opportunity if you meet the requirements to sell your stock without paying gain. There's a gain exclusion on the sale of stock. And there are a lot of planning opportunities around qualified small business stock that could maximize that gain exclusion. You could talk about estate planning opportunities, gifting some of that small business stock. One of the plans out there is, if you gift small business stock to your heirs, each heir gets the capital gain exclusion. So you can really, really maximize the planning opportunities if you have qualified small business stock. Now, this is only qualified for C Corp. It's not, S Corps and partnerships don't qualify for this gain exclusion. But again, when we're looking at sunsetting Tax Cuts and Jobs Act and whether or not it makes sense to change your entity election, this could be one of the planning opportunities that you want to look at when you're looking through those types of opportunities here. That's all I have for today. Like I said, 2022 was not a big year for tax legislation. There's certainly been some regulations and clarifications that have come out. I didn't feel like we had enough time to dive into those, and a lot of them are very, very specific and not general. There's been some foreign tax credit legislation. If you take foreign tax credits, there could be some changes there. But that's a pretty specific population, and I didn't think today was the time to get into those details. But I think 2023, I hope, is going to be a little bit more consistent. I think we're sort of evened out as far as getting a lot of fast and furious tax legislation, and I think the split Congress is going to help keep us a little bit steady and be able to be in a position where planning isn't quite as difficult, although keeping an eye on these sunsetting provisions that are coming up with in 2026. Sarah, are there any questions?
No questions, Sarah. Thanks so much for your insights. We'll probably hang around here for a few more minutes in case any trickle in, and certainly people can grab your email or mine and ask some questions.
Yes, please feel free to reach out. We appreciate you guys taking the time to spend with us today. And like Tara said, we'll hang around just to make sure no questions trickle in. But if not, everybody have a great day and enjoy the holiday season.